Effective corporate governance of banks and financial institutions is essential for the health of the economy. It can help to build an environment of trust, long-term stability, and business integrity. Trust is the foundation of any financial system. It enables customers, investors, regulators, and other stakeholders to have confidence in the soundness and reliability of banks and financial institutions. Trust also fosters innovation and growth, as it lowers the cost of capital and reduces the risk of financial crisis. Long-term stability is the goal of any economy. It ensures that banks and financial institutions can weather shocks and uncertainties and provide consistent and sustainable services to their customers and society. Long-term stability also supports economic development and social welfare, as it creates opportunities and reduces inequalities. Business integrity is the value of any organization. It reflects the ethical standards and practices of banks and financial institutions, and their commitment to transparency, accountability, and responsibility. Business integrity also enhances reputation and competitiveness, as it attracts and retains customers, investors, employees, and partners. Effective corporate governance of banks and financial institutions can help to achieve these outcomes by ensuring that they have a clear vision, mission, and strategy that align with their stakeholders' interests and expectations, a strong board of directors that oversees the management and performance of the organization, a robust risk management framework that identifies, assesses, monitors, and mitigates the risks facing the organization, a comprehensive internal control system that ensures the accuracy, completeness, and reliability of financial reporting and disclosure, a culture of ethics and compliance that promotes honesty, integrity, and professionalism among all employees and stakeholders. By implementing these principles and practices, banks and financial institutions can enhance their corporate governance and contribute to a more stable, resilient, and prosperous economy. The banking sector faces many challenges and risks, such as credit risk, market risk, operational risk, cyber risk, money laundering and terrorist financing risk, and climate change risk. These risks can affect the stability and integrity of the financial system and the economy as a whole. Therefore, it is essential that banks have sound and effective governance arrangements to identify, manage, and mitigate these risks. The Basel Committee on Banking Supervision, BCBS, and the European Union, EU, have issued principles and guidelines for good governance of banks to promote public confidence and uphold the safety and soundness of the banking system. These principles and guidelines cover various aspects of governance, such as the role and responsibilities of the board of directors, the risk management framework, the internal control functions, the remuneration policies, and the product oversight and governance arrangements. The BCBS revised its corporate governance principles for banks in 2015 to reflect the lessons learned from the global financial crisis and to address new challenges and developments in the banking sector. The revised principles provide a framework within which banks and supervisors should operate to achieve robust and transparent risk management and decision-making. The principles emphasize the critical importance of effective corporate governance for the proper functioning of banks and stress the importance of risk governance as part of a bank's overall corporate governance framework. The principles also recognize that compensation systems form a key component of the governance and incentive structure through which the board and senior management convey acceptable risk-taking behavior and reinforce the bank's operating and risk culture. The EU has also developed detailed guidelines on internal governance for banks in line with the requirements of the Capital Requirements Directive, CRD, and the Investment Firms Directive, IFD. The guidelines aim at further harmonizing institutions' internal governance arrangements, processes, and mechanisms across the EU, taking into account the proportionality principle. The guidelines clarify that identifying, managing, and mitigating money laundering and financing of terrorism risk is part of sound internal governance arrangements and credit institutions' risk management framework. The guidelines also specify and reinforce the framework regarding loans and other transactions with members of the management body and their related parties, which may constitute a specific source of actual or potential conflict of interest. Furthermore, the guidelines provide new guidance on the code of conduct to ensure that credit institutions take all necessary measures to avoid any form of discrimination and guarantee equal opportunities to staff of all genders. In addition to internal governance, the EU has also issued guidelines on product oversight and governance arrangements for retail banking products, such as mortgages, personal loans, deposits, payment accounts, payment services, and electronic money. These guidelines aim to address some of the conduct risks that may arise from the design, marketing, or sale of these products to consumers. The guidelines set out requirements for manufacturers and distributors of these products to ensure that they are designed to meet the needs of a specified target market, that they are tested before being brought to market or distributed to customers, that they are distributed in a fair manner that takes into account customers' interests, objectives, and characteristics, and that they are subject to regular reviews to assess whether they remain appropriate for their target market. By following these principles and guidelines for good governance of banks, both at the internal level and at the product level, banks can enhance their risk management capabilities, improve their decision-making processes, strengthen their accountability and transparency, foster their ethical culture and values, protect their customers' interests, and contribute to the stability and resilience of the financial system.